I can see arguments both ways. I certainly lean towards the hold, but won't be surprised to see the hike. Kia ora, and welcome to the New Zealand Property Market Podcast, brought to you by Cotality for the 6th of July 2026. I'm Head of Research Nick Goodall, and I'm joined as per usual today by our Chief Economist, Kelvin Davidson. Kelvin, we've got the first AB's test of the year to review and an official cash rate decision to preview later on. But first, do you want to take us through the release of the June Home Value Index from last week, mate?
Yeah, modest fall at the national level. We had minus 0.2%. So again, it's probably neither here nor there really. It's just a continuation of that pretty flat picture we've had for quite a long time now. No surprises given the Iran conflict, and interest rates have come back down again a little bit in the past few weeks, but previous rate increases, there's always going to be a bit of a lag in there. So still subdued sales activity, lots of listings. So there's no real surprises in here. Down minus 0.2%. Even the regional picture still looking pretty same as well. We had Auckland down 0.5%, Wellington down 0.4%. Mostly in Wellington City, that one was. We kind of look at a wider Wellington area across the big four TAs, and the other ones actually, if anything, sort of ticked up, but Wellington City itself was down, sort of dominated that overall Wellington figure. So, yeah, but a bit of extra weakness there, but that wider story of Auckland and Wellington underperforming is still very much there, as opposed to amongst the main centres. Christchurch up a bit, Hamilton was up 0.5%, I think, from memory. So, these aren't massive differences, but again, it's just that, I guess, continuation of the sluggishness in some areas, and a wee bit more resilience, maybe you'd call it, in other areas. Did see Invercargill and Queenstown went down a little bit in June, which is going against what they've had in previous months. May well be a blip, but I think it is probably just a good reminder that there's still caution out there, even in Queenstown or Invercargill. There's still restraints on the market. So yes, there's probably more supports as well, but there's also restraints. So just I guess a reminder of that caution that's out there. And I guess it's looking ahead, I suppose, with the peace deal. Will it last? Who knows? I mean, it's probably gone a little bit quiet on that in the last few days. Maybe it's Independence Day stuff, not sure. But yeah, seems to have gone a bit quiet on that. So I guess we're all obviously hoping that it lasts, and maybe we see interest rates hold down a little bit lower, economy recovers, might see a bit of growth in property sales, and maybe a little bit of growth in property values. But does it transform things? It seems a bit unlikely. There's still a lot of listings out there. There's still that cautious mood. So, even if the market does look a little bit stronger in the second half of the year, it may not be sort of a new boom or anything like that. And I guess just this mood shift seems pretty real too. I guess this sort of mindset change, and we had various meetings last week with different I guess audiences across different segments. It was property investors, sort of development community, advisors, mortgage advisors. So quite a diverse range of people there. Across all of them, it was a fairly cautious mood. People are aware that there's a lot of stock. It's a buyer's market. There's the election coming up. There's definitely caution around what that might mean for property investors. So I think even if we do see the peace deal hold and we see interest rates stay a little bit lower, there's still just those reasons for caution. So it's trending sideways, I guess, is a good way of putting it.
Yeah, for sure. Yeah, it's hard to, I know we're never going to foresee every factor that could affect the market, but it's sort of hard right now to propose a situation at which is going to see strongly growing house prices. I suppose you'd need a lot of things to happen, and maybe that's why there's that cautious attitude out there, because it's like, yeah, but there's heaps of stock and interest rates are going to go up and the economy's not great, and so it's kind of, you need all those things to turn around, and while there is caution and and there's still going to be the lag effects of the global impact of the war in Iran, even if it is to a genuine peace deal, which I suppose ultimately, if you measure it on oil tankers coming out of the Hormuz Strait, then it looks like things are going pretty well there. There always seems to be a little hiccup every couple of days, but still seems to be flowing. So if that's your measure, then it looks like we're sort of past the worst of it. But even with that, it just doesn't seem like things are going to turn around quickly, in the economy, global economy, or flowing through to the housing market. And I suppose that's sort of come through in that those conversations anyway. Also, I think we'll touch on it shortly, because we have sort of seen a bit of a rebound in consumer confidence. So I suppose people are feeling a little bit better, but for that to translate to reality, I suppose, is the key point. Before we sort of get into an official cash rate preview for Wednesday, I want to and then talk about the last sort of few bits of economic data we received in the last week. The other Cotality release that went out last week, or today, there was a bit of coverage, but then there's a full release that's gone out today under embargo for tomorrow. And this is some great work that's gone on by our analytics team, looking at the impact of particularly Cyclone Gabrielle on the price of properties in Hawke's Bay and Auckland. So both the initial price also, but change over time. Worthwhile going and looking at the full release. As I said, I'll put a link to that. It won't be available until Tuesday, but you'll see there's some online articles for some journos that got early releases of this data. And it was a follow-on from the presentation that our Chief Data Officer did at the Credit Risk and Fraud Conference at the end of May in Napier. So it sort of just followed on from this. There's been a few other conversations happen around this, but we've got to put a sort of full release out about it today so you can go and look at it. But I suppose just very quickly, the key insight from that piece is just shows that, properties that are at risk of greater flooding do tend to be relatively cheaper. So when you look at the actual median value of those with a higher risk or those that have been affected, they do tend to be slightly lower valued, but then their price has been more resilient over time, mainly because they're more affordable. So it's one of those things, right? Because they're more affordable, there's higher demand for them. People are still able to buy those properties. And in many cases, it looks like people are willing to accept the level of risk because it gets them into the market, and that attractiveness of being affordable means that demand stays higher, and so it actually pushes prices up or holds prices higher, maybe more importantly, over time. So I think, and the big reasoning for this, I suppose, is that, it's going to take time to improve the knowledge and awareness of this risk. People at the moment are buying it anyway. And if you personally insure for it and you're getting the right insurance figure, another question, of course, that we're hoping to answer a bit more soon in terms of making sure it's that full sum sure rebuild value, then, fine. If you're happy to and able to and willing to pay that insurance premium, then I think it's not the biggest deal, I suppose. I suppose the concern comes around where people go, there's been this level of accepting, in big events, big weather events, big flooding events, earthquakes, of course, there's been the Earthquake Commission, now called the Natural Hazards Commission, who essentially bail us out, right? So if you're not fully insured or you need to be bought out to be able to move on and have to wait for full insurance processes, then the government essentially steps in, right? But I think we're getting a pretty clear message from the government and those that are in this space that that's not going to occur forever. And so we can't sort of continue to rely on this government being the backstop. And so we need to ensure that, if that's going to be true, then the information has to be available to these people to make sure they're making educated decisions and not buying property and not accepting the risk or getting that fully covered, and later on just accepting or hoping that they're going to be bought out. So if that doesn't occur, then you're going to be the one that's stuck, I suppose, if a big event does happen and you're not fully insured for that property. So yeah, I think that's part of the conversation here. There's obviously there's this natural map. Flooding map, national flooding map, which is due to be released in May of next year, which does make sure that the data is sort of available in every consumer's hands. And I think that's what everyone's been looking for, right? Is some centralized information here so that it's all the same. There's different models out there. We've got one, of course, and there's other organizations that have their own, and those are feeding, whether it's insurance companies or banks and their lending decisions and all sorts. Government organizations have got versions of them, and regional councils have got some, but it's inconsistent across the country. It's about making sure this information is consistently available to everyone out there. Then you can start to say, yep, the information's for you. If you don't acknowledge that or don't prepare for that, then don't expect any help at the other end of it. But anyway, that's the broader conversation I think that'll come off the back of this. There is, as I said, there's been some articles out there already. We've been presenting it to our clients already as well, but that full release will be available tomorrow. So check the website out for that one. I'll change the show notes so that from tomorrow that link will be linked. The article will be linked. But yeah, that's a worthwhile one to go and check out as well for anyone that's sort of across the industry anyway. Yeah, any thoughts on that, mate, before we do look at sort of little quick economic review to preview the OCR?
Yeah, I mean, obviously a massive issue. A couple of my presentations last week it definitely come up around flood scores and what it means, and how they're calculated, which is a wee bit beyond my core area of expertise. But yeah, it definitely creates some conversation for sure, and rightly so, because it's a huge issue, and it's been festering around for a while. I suppose I remember going to insurance conferences 4 or 5 years ago, probably, and it was being talked about then. So, maybe it's a slow burner, but the more and more common these events get, and I guess the higher the profile, and the more data we can put together and analyze and use our sort of internal systems, the better. Yeah, I mean, it's one thing if you can get insurance now, great, at a reasonable cost, but there's that uncertainty for people, I guess, about, well, can I get it in 10 years? So, and if I can get it, what's it going to cost? Like, is it effectively uninsurable? The premium might be way too high for me to afford. So, those things are definitely on people's minds. So it's always been an uncertainty in my mind as well, how much is it actually being priced in? It's very difficult for Joe average buyer and seller now to factor in that uncertain cost and risk over an uncertain long period of time. But yeah, it's cool to be able to put data around it and at least start that quantification. So yeah, big issue, and more data we can do, the better.
Yep, and as I say, there's more to come on this. I mean, there's got to be some sort of transition. People that have owned their house for 20, 30 years and find themselves in a risk area, which they would have had no idea about when they first bought it, right? Or it's changed a lot since then. So, yeah, look, it's not going to be an easy one or a fast thing to resolve. But as I said, the more the information can get out there, the more we can help people understand it, then the better those decisions can be in the future. So, yeah, plenty more in that space to come. All good, mate. Well, do you want to give us a quick review of the last bits of economic data that we've tracked, and we know Reserve Bank will be acknowledging as well. I think you had Phil Jobs, consumer business confidence data, and then we can talk about our expectations for Wednesday.
Yes, I suppose it's how much weight you put on the incoming data versus what they think about what's to come. Because obviously the Reserve Bank's big consideration is the so-called second round inflation, which is if anything probably still down the track. But yeah, I think probably these figures we had last week on the whole positive, and encouraging if you want economic growth and you want jobs growth, which I think we probably all do. Does it sort of bring up the chances of an OCR rise? Maybe not. So I think that's probably where I sit. But we had consumer and business confidence both rebounded on the ANZ surveys for June. No surprises there. I mean, you look at falls in fuel prices, that's going to have a big impact on households, how they're feeling, and also businesses as well. Maybe those fuel surcharges are coming down. I'm not sure about that, but that's going to play a role. So probably no big surprises there. I guess in terms of sort of monetary policy decisions and overall spending and that sort of thing, confidence is still lower than sort of where it was. So yeah, it's bounced up a bit, but it got down to incredibly low levels in the meantime. So it's kind of that sort of balance thing that yes, it's risen, but the level is still a bit lower than where it was. So that's sort of the overall conclusion there. We had filled jobs up 0.3% in May. So, decent result. But when you look over a full 12 months, it was only up 0.6%. And partly those initial monthly figures they've always looked pretty good on the first release, but these filled jobs numbers can get revised, and they tend to get revised down. So I think, probably if you'd been watching them for the past 3 or 4 months, each initial reading looks pretty good, and then it's revised down, and it's sort of, it doesn't look as good as time passes. And I think you probably see that in that 12-month increase, that it's only 0.6%. So, initial reading looks good. Let's take it at face value. It's encouraging. Of course, we've got some jobs growth, but, when you look slightly longer, it's probably still fairly middle of the road, which again fits with just a cautious mood out there, and obviously what we've seen over the past sort of 3 or 4 months. And jobs growth at that level probably isn't really strong enough to absorb labour supply, migration coming in, new people coming into the labour force. So in terms of the unemployment rate, does it look like it's going to change much in the near term? Probably not. So that's sort of a restraint on the housing market, but also I think we'll probably just add to the cautious mood perhaps that might be within the Reserve Bank there. If the unemployment rate hovers above normal, then that would argue for not necessarily a big rush to increase the OCR. So yeah, I mean, you take them at face value, they look good, but does it change the thinking? Is it 1 the terrace or 2 the terrace? I can never quite remember, but does it change the thinking there? Probably not.
Yeah, I think that's fair. I think, like you say, on the face of it, it looks a bit more positive for the economy. So anyone in the committee that was going, we don't want to raise the official cash rate because it's going to stunt economic growth just as it's trying to get started, you could maybe say there's an argument to say, they can relax on that feeling a little bit. But I still think that everything else that should be driving their conversations will still be stronger than those last two little bits of information. Particularly, I think, as you said, the second round level of inflation doesn't look like it's going to take off. And so I think, and I think the signs of oil prices coming down, gas coming down, the likelihood of inflation reducing off the back of that, I think is quite high. I also read some stuff last week, which sounds like it's pretty real, where there's a genuine chance here of there being an oversupply of oil around the world at some stage in the future, because we have, not just us, but globally, there's been this shift forced upon us almost to electric. And so now our level of demand and requirement for oil and gas and petrol has reduced. And so the level of production or level of supply going around the world doesn't have to be as much as it was prior to this. So it's kind of sped up the shift to more electrification and less reliance on petrol in itself. And so that could mean that, with the release of these extra level of oil and gas around the world, and then the supply starting to get going out of Strait of Hormuz again, that actually we might have a chance of oversupply. And, what does that mean? That means you discount your price to get it going, and that means a reduction in inflation as well. So, there are some arguments to say that this is actually going to see, well, maybe not quite medium term, maybe it's a bit longer than medium term, inflation actually see some more downward pressure on it. So again, definitely less need to have to fight this temporary high inflation right now with a higher OCR. So it's going to be an intriguing statement from the Reserve Bank this week. I thought the way to maybe we do preview this, and I think it's pretty clear you and I don't see an OCR increase required or expected. But we could sort of look at this by, I think reviewing the bank economists and other independent economists' expectations here. And for me, it was interesting that they kind of split. I think it's ANZ and BNZ that expect a hike. The rest saying hold. So I suppose that's a 3-2 vote to hold. Almost similar to what we expect for the Reserve Bank committee members. But it does just show how tight the call is right now as well. And I mean, you've been sort of saying for a few weeks now, can we see someone who voted to hike last time to now say vote for hold, or vice versa? And if it's vice versa, then would it be Anna Bremen, as she's got the casting vote as well? So it's trying to propose, some of those people getting their read on things changing quite a bit for them to change their vote, which I'm not sure we necessarily will. Maybe we see a similar vote. But there are also some economists out there saying that they expected it to be a unanimous hold. So there's definitely a varying view here, which just shows how difficult it is to make the call here. And as we've said over the last few weeks, just how easy it is to read the same data in multiple different ways, depending on maybe how much weight you put in one, the depth of some you might go into. So it's a tough one. If we say it's about even 2-3 split or so, a couple of the independent economists, I did see that Cameron Bagri and Tony Alexander, if we call them our casting vote as independent economists, they sort of say they expect to hold. So I do think we're leaning towards that now, which is quite the change on whatever it would have been 2 or 3 weeks ago. And certainly 6 weeks ago, when we all expected it was a lock-in for an increase, and shows how much things can change in a pretty short space of time anyway. So, I think we'll see the vote. I think we'll see it hold, but I wouldn't also be surprised to see it lifted 0.25. I think, ANZ's chief economist Sharon Zollner sort of spoke about, if you're going to get a lift in, get it under your belt nice and early. And get that signal to market. If they don't follow through with that, then it might show that, their tone recently of we need to have some increases, we're going to have to tighten in the future, want to be taken seriously if you don't actually get one of those done, or, they're not obviously changing their forecast this time around. We're not getting updated their forecast. So, we're not going to get that indication that there's going to be some in the future. So maybe the best way to get that signal to market that, we're still going to see a higher OCR is to do one of them now. So as I say, I can see arguments both ways. I certainly lean towards the hold, but won't be surprised to see the hike. But mate, any I don't know, extra thoughts, any detail you want to jump into? How are you reading this one? Over to you.
Yeah, for me, I think you'd hope the focus is actually on the economics rather than the kind of individual votes. But you'd hope that a decision is based on, and the way we should analyse it and think about it is, how is capacity and how is inflation and what's all the, business sentiment and all of this like. I mean, I've got to say, I still think that probably leans towards the hold argument as well. It just feels like, that there's not necessarily any rush. I suppose the bar to raise the OCR seems higher than just keeping it unchanged and just waiting to see what happens, particularly with the. I mean, you're probably never going to know if you've got second round inflation until you've actually got it, but it just doesn't seem like there's too much sign of that, and particularly with fuel prices coming down in the meantime. So I think the economics probably does justify the hold, but there is this other layer now. We've got the vote, and like I say, you'd probably want to analyze it on the basis of the economics and the inflation and GDP and everything, but the vote matters now too, and it just seems like to get that OCR increase, you've got to get someone changing ship, and does the data justify that over the past few, well, 4 or 6 weeks, I guess, since the last decision? I mean, maybe not. It just feels a bit difficult to imagine one of those people who, I mean, you'd have to have the same three people, or, well, not necessarily the same, but you'd have to have three people voting for that rise, and then you'd have to have one of those holders jumping across and going, you know what, the data's now strong enough to justify that increase. It doesn't feel like that has really changed. Now, you'd hope that's a secondary consideration, but it is real too. So I think when you weigh up the kind of economic environment and you look at that voting record and you think about the mechanics of what it would take to get that OCR increase, it just feels like it's probably leaning more towards that hold. But I like your phrase, whatever it was there. You kind of anticipate the hold, but wouldn't be surprised with the rise. I mean, that's seems to be a pretty good way of summing it up. So yeah, I mean, 2 o'clock Wednesday, we'll all be sort of clicking, waiting for the website to update. Yeah.
Yeah. Yeah, nah, all good, mate. We'll hang out for that, and we'll record straight afterwards again. So we'll be able to have that initial reaction to what they said, to which way the vote went, what weight they might be putting into each of the different data they're receiving. So yeah, we'll chat all about it on Wednesday afternoon anyway. So yeah, keep an eye out for that one, or an ear out for that one on Wednesday prior to hopefully 5 o'clock. I'd say should be us. Other things this week, we've got the CCCI, the Goodall Construction Cost Index, coming out for Q2 later this week. I think they'll actually be out on Wednesday morning. So yeah, a few things to look out for this week. We'll have that, climate analysis out tomorrow. We'll have CCCI on Wednesday morning, and then we'll have the podcast after the OCR decision on Wednesday afternoon. So a busy couple of days coming up, mate. Anything you want to say about CCCI or anything else to prep for this week, Kelvin?
I think I mean the CCCI. I don't think there'll be too many surprises there. People. There's already been a few kind of articles written over the past week or two about construction, and pretty much along the lines of, costs are up, surcharges, some materials seeing rises now, but also, labour's a big part of it, and there's probably a bit of capacity in that construction sector, and builders seem to be absorbing these costs for now. So the actual pass through to the end user perhaps isn't as high as what might have happened. So that's the numbers are they've accelerated a wee bit, but there's still a reasonable degree of control in there as well. It's not a big spike in construction costs yet, and maybe the peace deal's just come along at exactly the right time, when we don't see those price increases. But yep, for now it's just ticking along.
Yeah, I think that's a good way of putting it, and yeah. I think we have heard that the builders are having to shoulder a lot of the increases they're taking on. They can't do that forever, of course, but some of it's passing through, not quite as much as they're having to handle themselves, which is we think is almost certainly going to have a slowdown in activity coming through later this year off the back of all of this. But yeah, that's a decent little summary. But again, go and check that out later in the week, and we can maybe touch on it in a little bit more detail next week anyway. But yeah, we'll sort of leave that there. So that's all for today from a economic and property market perspective. So if that's all you are here for, thanks very much for listening, and we'll see you or catch you on Wednesday. Kelvin, from a personal perspective, I mean, there's plenty of sport to chat about, and we are in school holidays now, so she's a busy old couple of weeks trying to juggle home and work life. But you, of course, went along to the All Blacks game at Kaha on Saturday night, mate. What was it like in person? I certainly enjoyed it, watching from the comfort of my home on Saturday night.
Yeah, no, it's good. Yeah, it's great. I mean, I'm a bad sports watcher live because I end up not even watching the sport, or if I am, I'm watching the screen rather than what's happening right in front of me. I tend to, I was there with a group of guys, so you end up yarning, and I saw some other people I knew as well, so you end up chatting to them. So yeah, it's definitely going live is more about the social side of it rather than necessarily the sport, and you don't get that kind of expert technical commentary that you'll get on TV, but Yeah, I mean, entertaining. So I didn't, I mean, having not fully focused on it, I didn't fully I wasn't that tense, even though it was obviously a close game. It was probably, more the entertainment factor than anything. And some good tries. And I don't know, maybe you can argue that they'd want to tighten, I mean, both teams maybe want to tighten up their defence, who knows? But certainly from a spectacle point of view, there's lots of good tries, and seemed to be some good passing, and I've only really figured out afterwards not as much kicking as maybe you'd otherwise anticipate. So yeah, no, it's great, and good entertainment. The obviously not affected by the weather, and you're in and out of that stadium pretty easily. So yep. Yep, really good. But I kind of picked up a cold on the morning of the game, so it perhaps wasn't the full enjoyment that I might have otherwise had. But it did mean that we didn't end up having a late night either. So that that's got its benefits on Sunday. So yeah, swings and roundabouts. But great. That's I mean, people are still raving about the stadium. It's that wider, but I think it's that wider thing as well. The wider cities got the influx of people, and everything's busy, and all these new facilities being used fully in terms of bars and restaurants and things. So yep, really successful. Enjoyed it.
Yep, I'm super jealous, mate. I remember going to the first All Blacks test down in Dunedin when their stadium opened up. And I still haven't been to Kaha, so I'm feeling very left out. I am scheduled to be down there for a concert either later this year or early next year. So, I know I'm going to have my debut to come and see the stadium, but still yet to see it, and definitely not in a sporting situation. So, yeah, very jealous. But I can tell you, yeah, certainly watching it on TV, it was entertaining. You did notice the lack of kicks, which was just an absolute blessing. And sounds like some of the other games were like that too, the Aussie Island game as well. So, look, hopefully that means international rugby's back. I wouldn't get too carried away. I'm sure South Africa and England will drag us into some sort of arm wrestle and kick fest at some stage. And we've got the tour to South Africa this year. So, we're certainly going to find that out in the not too distant future. But yeah, look, it was an entertaining game. And yeah, like maybe some defence needs to be improved on, but maybe we can just give credit to the great attacks. And they just looked really good, scored some great tries, and yep, certainly was a good spectacle. So happy days on that one. There's no doubt about that. And yeah, I'll be along there this Saturday to the Cape Town to watch us take on Italy. Suspect we might get a few changes to the team. Maybe a debut for the likes of Morby, and a few more of those Canes will get a start. So, it could be close to a Hurricanes team maybe. But as a Hurricane supporter, I would say that. But yes, look forward to that one. Otherwise, mate, I don't know if there's anything else on your mind. World Cup, of course, rumbling on. Saw this morning Brazil have now been knocked out. So that's a pretty huge result. And Norway going on to the quarterfinals there. So that's a pretty massive one, to be honest. And I suspect we're going to see a few more upsets like that. We've got Mexico playing England shortly, actually. So, yeah, hoping to be able to keep a half an eye, if not a couple of eyes on that one today. But certainly been enjoying the games over there in America. Yeah, mate, that's pretty much all for me. I mean, yeah, just typical sporty Saturday for me and the kids and whatnot. And yeah, otherwise trying to figure out ways to keep these kids entertained over the next couple of weeks and still get in for work stuff, and Martiniki, of course, on Friday as well. So nice to have that long holiday, long weekend scheduled, and see if we can get away for a little bit. But yeah, that's pretty much all on my mind, mate. Anything else on your mind?
No, it is the toughest holidays, this one, isn't it? Being in the middle of winter, and the weather's, I mean, around Canterbury in particular has been really good for a long time, but it's definitely packed it in just recently, just in time for the holidays. So bit of Murphy's Law there, but is what it is. I mean, a couple of hours, I guess. Given the amount of English people that'll be in New Zealand, the pubs over lunchtime will be pretty full, no doubt, with that football on. So yeah, go England, I guess.
Yeah, I think we got away. Well, I have quite liked Mexico, and the supporters are crazy, and that stadium's amazing. So, yeah, there's definitely a hint of mine that wants the Mexicans to do it. So, hey, either way, I got no major stake in it, so I can just sit back and enjoy the game. And again, hopefully it's entertaining, see some goals and plenty of excitement. But that'll do us for today, Kelvin. So I will leave it there. But thanks, as per usual, for your thoughts and insights. Look forward to hearing how all that goes when we catch up again on Wednesday and review the Reserve Bank's decision. But that's all for today. My name is Nick. He's Kelvin. You've been listening to the New Zealand Property Market Podcast. Mā te wā.